Welcome back to Inside the Wall. In this episode, we will conduct a feasibility analysis of the potential Paramount Skydance acquisition of Warner Bros. Discovery, looking at the strategic rationale, financial capacity, and execution risk. Before a company pursues a mega deal, it's usually reacting to pressure, not strength. Paramount Plus has 79 million subscribers, but that still lacks the global scale needed to compete on cost, content, and advertising against streaming giants. Meanwhile, its legacy TV business is shrinking fast, with ad revenue down double digits. Management has even begun amortizing broadcast licenses, formally admitting those assets are losing long-term value. Add heavy restructuring charges, and the message is clear. Paramount is being pushed into consolidation by structural decline, not opportunism. Strategic ambition only matters if the balance sheet can support it. Paramount's filing suggests tight financial capacity. Operating cash flow relies heavily on non-cash add-backs, masking weak underlying cash generation. Management even expects reported free cash flow to turn negative in 2026, due to roughly $800 million in transaction and restructuring costs. At the same time, Paramount plans over $1.5 billion in incremental content spending while ad revenues are falling. With interest coverage at just 1.8 times, there's little margin for error. Bottom line, Paramount cannot self-fund a WBD-scale acquisition and would be betting heavily on future synergies to make it work. The balance sheet ultimately decides whether a mega merger is possible. Paramount already carries nearly $15 billion of debt, and management has openly said its leverage limits strategic flexibility. While near-term liquidity is stable and maturities are well-spaced, taking on the massive debt needed to buy Warner Bros. Discovery would directly conflict with its stated goal to deleverage and likely trigger credit downgrades. As a result, any realistic Warner Bros. Deal couldn't be all debt-funded. It would require heavy equity issuance, asset sales, and likely outside sponsors, highlighting just how complex and high-risk the financing would be. A company's segment reporting shows where it sees its future. Paramount's filings make that clear. Linear TV is being managed for decline, while streaming and filmed entertainment are the growth priorities. TV media is shrinking, and even its broadcast licenses are now being amortized, an admission those assets aren't the future. That's where Warner Bros. Discovery fits. HBO Max delivers instant global streaming scale, Warner Bros. Studios adds premium franchises, and TNT Sports plus CBS Sports would create a dominant sports platform. Meanwhile, Warner Bros. Linear networks could generate cash to fund the transition. The merger logic is a strategic asset swap to accelerate Paramount's pivot to growth. How a media company accounts for content tells you how much it believes in its future. Paramount's filings sends a clear message. Management is now amortizing $2.5 billion of broadcast licenses, signaling those assets have a shrinking economic life. Ongoing impairment and restructuring charges point to declining returns on legacy investments. While much of its contracted revenue is tied to cord-cutting exposed licensing deals, the implication is collapsing ROIC. That's the motive behind Warner Bros., a flight to higher quality assets. HBO, DC, and the Warner Bros. Library offer durable global IP that can generate returns for decades, not years. Mergers don't just add assets, they multiply risks. Paramount's own filings highlight why a Warner Bros. Deal would be especially complex. Paramount is already dealing with shareholder lawsuits tied to the Skydance transaction and thousands of legacy asbestos claims. Layer in Warner Bros. Own litigation and legal risk balloons. On labor, Paramount has hundreds of millions in letters of credit backing talent and production contracts, in an industry still vulnerable to strikes. Finally, Paramount already operates across multiple countries, but Warner Bros.' global footprint would dramatically expand regulatory and compliance complexity. The takeaway: a Warner Bros. Merger would significantly raise legal, labor, and execution risk. Antitrust and regulatory friction present significant market concentration red flags. The merger would create a highly concentrated player across broadcast TV, cable networks, film studios, and streaming, likely requiring divestitures as a remedy. Sometimes what management doesn't say matters most. Some key gaps stand out. There's no clear timeline or target for standalone streaming profitability. There's also no detailed funded roadmap showing how Paramount can organically reach global scale, despite claims it, quote, has the ability to build. And while management mentions dividends, content spend, and deleveraging, it never lays out clear capital allocation priorities. These omissions weaken the standalone story. Without a credible organic path, a Warner Bros. Acquisition starts to look less like an option and more like management's only realistic solution. When you put all the evidence together, the logic becomes more clear. Based solely on Paramount's disclosures, this deal is driven by existential pressure. Paramount lacks global streaming scale, and its legacy assets are in long-term decline. Acquiring Warner Bros. Discovery would be a strategic asset swap, trading up into premium IP, a scaled streaming platform, and near-term linear cash flow. But the risk is extreme. The deal would require massive leverage, compounding legal, operational, and regulatory risks. If synergies fall short, the downside isn't disappointing returns. It's an existential debt spiral.